So today's video is about a new Wall Street mirage. You see, right now, because of the quarterlies that we just experienced in the entertainment industry, the magic of free cash flow seems to be affecting people's decision-making process. And look, we exist in a world of financial turmoil, and no sector has been spared at the moment, especially not media. And within that media industry, there's one recurring act that seems to captivate Wall Street analysts and investors, and it's this hypnotic chant of free cash flow. It's not even a new strategy, but right now it's as if the executives at all these entertainment conglomerates have stumbled upon their new magic words, and that's gonna, well, help make the financial concerns disappear. In fact, if you remember their previous voodoo, it was something about streaming subscription growth. Now, before we get all swept up in the allure of this free cash flow statement, it's time for a reality check. And I've got the block of reality ready to drop on this lie like a ton of bricks. Are you ready? Here we go. So before we jump in, a quick reminder to double check that you're still subscribed to the channel. Or if you're not, please do so. It's free. And if you aren't subscribed, you would be doing me a giant favor. See, our next milestone from 10K is obviously 15K, and after that 20 and 25, because the goal is growth and we want it to be meaningful. So it'd be incredible, would be very incredible if you would just, end up clicking that button and turning on your notifications. That way you don't miss anything. I'd like to get to 15K by the end of the year, and that'd kind of be like a Christmas present for me. So thank you in advance, and now we'll jump right in. You see, in the midst of the writers and actors pounding the picket lines right now, media giants are fervently waving sparkly, glittery banners emblazoned with the words profit and free cash flow. And that is hopefully being received in a way that actually soothes the nerves of their institutional investors and even retail investors like me. I mean, this obviously was instigated or prompted in response to the lukewarm Q2 earnings that were delivered by most of the major entertainment brands. And of course, these executives served up these frosted piles of dung with linguistic gymnastics to ensure that only their optimism shone through. In terms of verbal wonderment diarrhea, Warner Brothers Discovery executives took the lead with an astonishing 15 mentions of free cash flow, coupled with 11 nods to profitability during their most recent quarterly calls. It's funny because I had to go back and read a bunch of articles that actually caught this just as I did. And this left Disney, Comcast, and Paramount joining in a chorus, although a little bit more muted, singing the same praises of free cash flow as if it's going to be the remedy for all that ails you. Sadly, that luster fell off fast for those bean counters that were existing there in the institutional houses. They caught it. They hit the books and unmasked Disney specifically for the disappointment that it was. It benefited from what some people may have called a dead cat bounce, but boy did they hit the ground hard. But of course, that's a story for another time. And of course, I'll probably get to it next week because, well, there's a lot to that. And in a scene that's reminiscent of a magician's performance, where the real trick is diverting your attention from the fact that the current state of the media industry is far from rosy, there's an additional distraction that's being deployed here. And it's the constant assurance that the ongoing strikes have actually been a blessing in disguise. I'm not sure how they're going to try to pull that off, or continue to pull it off, because somebody bought it. You see, a glorious windfall of temporary cost savings, a mere, well, a couple $100 million, I should say. That's just kind of pocket change. I'm not sure why anybody got their skirt blown up by that. I don't know. Of course, within the beauty of emphasizing free cash flow lies its ephemeral nature. These pseudo-financial gains or strikes are as fleeting as a magician's vanishing act. Of course, we've already seen that trick before. And in other words, once the strikes end and the cameras start rolling again, those supposed savings will prove as lasting as a puff of smoke. But why worry about the future, right? When you can bask in the glory of today's smoke and mirrors, right? Let's not forget the real crux of the matter. The strikes have cast a dark shadow over media companies, especially in the PR area. And most especially with, well, in regards to their practices, which have been a little rough lately. And this is now impacting their earnings and the trust that advertisers have in their ability to deliver programming. This is not a good time for that because you've been trying to sell it throughout the summer. That's when you go out and say, this is all the things we have to sell. How are you going to flesh out content that you are currently selling if you're not making any content? That's a problem. Naturally, There's a reason the world turns to free cash flow as a beacon of financial prowess. It's not just about those numbers or even the statement. It's about what those numbers actually signify in the larger sense. In the simplest possible way of thinking or describing it, it's the ability of a company's potential to pay off debt, invest in growth, and maybe even toss a few coins into the dividend, which everybody's been clamoring for. Oh, and don't forget the magic trick of buying back stock, because that actually works, pumping up your price. But here's the rub. While fluctuations in free cash flow are normal, prolonged negative trends are the cause for any kind of concern. It's like when your paycheck takes a hit because of an unpaid sick day that you had to take, or you had to take your dog to the vet, or whatever, right? That's not a big deal, but a sustained unpaid absence, or a string of them, starts to take a huge toll on the savings account that you may have been building up over the years, if you've been smart enough and had the foresight to do so. In that situation, you're probably starting to sweat those monthly bills. I know I would be. Now, take Paramount, for example. It's been trapped in a downward spiral of negative free cash flow since Q3 of 2022. So basically an entire year. Yikes. And that's been a relentless outpouring of resources despite parting ways with non-core assets like they're holding an entertainment yard sale. They even managed to actually offload Simon & Schuster after multiple attempts, and they got a nifty $1.62 billion for it. Well done. But they recently abandoned plans to sell off a majority stake in BET, which experts claimed wouldn't have done much to improve their financial well-being anyway. Wow. That's, of course, just a minor setback, right? I mean, selling something off to improve your situation won't really help. That's a good thing, right? Oh, probably not. And I'm sure you've noticed that I haven't really gone after the Fantasyland company of Disney in this one. And you're right, because I'm saving it for their own special breakdown after a few more days of their, collapse. It's so bad over there, actually, it certainly deserves its own video, and, they're going to get it. So let's get back to the main point, and we're going to wrap up. As the dust is settling after the strikes and after the smoke clears, which is coming up sometime in the future, the true indicators of financial stability for the media giants will start to emerge. You'll be able to see what is actually going to happen, what's going to play out, who's actually going to be in the best situation. And beyond the supposedly magical incantations of free cash flow, the realities of streaming profitability, traditional television revenues, and the decline of advertising are the very real harbingers of doom here. They're the ones that are going to let you know. This will mean it's time for the media giants to put their money where their mouths are, or I guess in this case, their free cash flow where their deficits are, because they're going to need to do that. Wall Street will certainly demand the entertainment giants prove their financial strength. That's coming. They want to know that that's more than just the smoke and mirrors they've been selling for, I guess, almost 4 years now. And I don't think any one of these media companies, these entertainment giants, are even ready for that. But hey, what do you think? Is the game coming to a close soon for these media entities? Will they have to break into pieces to survive? And can they find their way back to profitability? These are good questions all, I think, and I'm sure I missed a few of them, but I'd like you to leave your thoughts in the comment section down below, because I think this is worthy of an in-depth conversation. And there are a lot of you out there that are brilliant that, may have some different perspectives, and I'd like to hear them. And with that, be sure to take care of yourself, take care of others, wash your hands, of course, because it's good hygiene. And until next time, see ya!